Okay, once again, good morning, everyone, and welcome to the first event of the Founder Series, which is an initiative of APACMed Startup Committee to support our startups, not just in Singapore, but across the region. So what I'll do right now is that before we go into the webinar proper, I thought I'll give you a little bit of a very short presentation about APACMed and the Founder Series. Especially for those who are online with us today and who may not be familiar with who APACMed is and what we do. Before I hand it over to Jeff from EY to take the dialogue further. So as an introduction, APACMed is short for the Asia Pacific Medical Technology Association. So a few things about APACMed. One, we are not for profit. Number two, we are set up by the industry for the industry. And what we do is that we lead efforts to advance MedTech and to raise the standards of care for patients. On to the next slide. I just want to share with you briefly a little bit about our membership. While our work is to raise, to be the voice of the MedTech industry in the Asia Pacific region, we are also fundamentally a membership-based organization. And we represent companies operating in three broad areas, medical device, diagnostics, and the digital health space. I just want to highlight two categories of membership. If you see the first category, the senior leadership, leading MedTech companies, these are representation from global MedTech companies. If you look at the top 30 MedTech companies worldwide, 20 of them are members of APACMed. And we are really proud and delighted to be associated with them. And we're hoping to leverage on the insights and leadership of our global MedTech companies. The other category, which is the in the middle, are the startups and the SMEs. And this is really, the startups and is really the next phase of our growth. Because if you look at the title there, 40% of APACMed members are local ASEAN headquarters startup members. And it is because of this group that we are running this founder series, to help the founders, the startups to advance and scale up, leveraging on our senior business leaders, our industry experts. Yeah. And the last slide, a little bit of a background on the founder series. So this is an initiative, as I've mentioned, that came out from the APACMed Startup Community. And the objective is really simple. One is to provide a platform to bridge startups with global organizations. Yeah, and number two, of course, we want to help our startups and our founders through their entrepreneurial journey. So if you look at the program, there are three components to it, or three C's to it. The first C is the Founders Campus, where we hope to give our startups access to experts. Experts meaning senior business leaders, and you see some of them at today's webinar, and also industry experts. Again, we have representative from EY as well that we hope to leverage as well. And how we hope to give you access to this expert. If you look on the right hand side of the slide, we have already planned out a series of programs starting from today right till 10th of December, where we'll walk you through various topics that will be very relevant to startups, whether it is M&As, today's topic, corporate investments, or functional issues like IP, regulatory strategies and reimbursement and go-to-market strategies. These are some of the areas that we will cover. The second component, the Founder Series, is where we hope to give you access to global companies. We have a partnership with MedTech Innovator, a US-based accelerator, which helps to bridge startups with global companies. But in addition to that, we also have facilitated a number of engagement between startups and global companies. So if there are startups who wants to be connected to the global MedTech companies, feel free to reach out to us as well. And last but not least, the last C, Founder Circus, which will give you access to the broader healthcare ecosystem. And this could include the investment community. It could give you access to APACMed's functional committee, and even some site visits like manufacturing site visits and R&D site visits. So this is what the founder series is about, and we are glad that you are part of this program today. So right now we'll move on to the webinar proper. The next slide, please. Yeah. So today's session is on innovation through M&A and partnership. And as of yesterday, we had 100 registrations on our website. I think some of them are still logging into the webinar. Very, very diverse group. We have representation from the global companies. Of course, the large amount of attendees are from the startups. We have attendees from public institutions, as well as service providers. Very, very diverse, attendees today. So I just want to kick off this, webinar with a survey that I read recently from INSEAD. So INSEAD conducted a study about startups trend in Southeast Asia, and they predicted that there'll be at least 700 startups exceeds, between the year 2023 and 2025. And this is just for Southeast Asia. Imagine if we include the entire Asia Pacific region. So this topic today on M&A is very, very important. And I'm sure we will all benefit from the dialogue and the insights from our senior business leaders and our industry leaders. I'll hand this session right now to Jeff from EY to take this dialogue further. Over to you, Jeff.
Thank you, Gabriel. Good morning, everybody. My name is Jeff Weisel. I'm Director of Life Sciences and Healthcare with EY here in Singapore. I'll be the moderator of the remainder of the session today. First of all, I just want to express our thanks to APACMed and Gabriel for inviting us to help kick off this inaugural session of the Founders Series. Very excited about this initiative and how we can help. Very quickly, we have a very exciting, I think, program for you this morning. We will start off with a short presentation from my colleague Abhay Bangi, just to set some context on how EY's perspective on M&A in the MedTech sector, and particularly how it's being used to drive new innovation. And then we will move then to a panel discussion with our three industry leaders who will introduce themselves at that time, and we'll go through that. So again, the topic is innovation through M&A and partnering, and just to set the context then, though we have, our panelists are all from the corporate side, we will be looking partly at how they view M&A as a part of their broader strategy, but we will then ask to drill down more specifically, so how corporates would be engaging in M&A and other forms of partnership, specifically with startups, and so it really bring that around to how the corporate side and the startup side can work together. So with that as a background, let me first turn over to Abhay. Abhay, if you don't mind, maybe just quickly introduce yourselves and a little bit about EY, and then we can get into your presentation. Abhay. Abhay, I think you're on mute, or we don't hear you. Dear.
Can you hear me now?
Yes, perfect. Thank you.
My bad. Abhay Bangi, partner with EY here in Singapore, lead our life sciences practice across the region along with Jeff. Very happy to be here, and thank you, APACMed, for the invite, and look forward to the discussion over the next hour.
Okay, so now, Abhay, over to your presentation. Go ahead.
Lovely. Again, good morning, everyone, and hope all of you are staying healthy and sane. We live in very interesting times. I've been tracking the Q1 earnings results announcements that have been coming out of the US for MedTech companies. And I guess it's safe to say that there will be a lot of near-term pain for the industry, but I'm sure all of us believe and hope that demand will bounce back and things will look better over the medium to long term. That said, I think it is important for us to use this opportunity to look at doing things differently and making incremental innovations a reality of our business going forward. With that as context to also our presentation for today, I wanted to dial back to where the industry was in 2019. Every year, EY puts out the pulse of the industry report, and we do try to capture some of the key takeaways from the trends that we're seeing in the industry. Overall, industry revenues kind of topped 400 billion in 2019, and we did see some growth, and I'll talk about that in a little bit. Financing stumbled a little bit, but financing for early stage companies and IPOs were definitely strong. We did see a lot of investment that was going into breakthrough technologies, especially robotics, and we did see a lot of interest from providers and payers to adopt to more data-driven approaches to care. And there was a lot of interesting commentary from MedTech participants on how they can deliver care given this new shift to data-driven platforms. And that's kind of how we see the industry evolving as well. I think in version 1.0, it was about blockbuster drugs, then it moved into diversified portfolios. Then over the last decade or so, everybody was talking about value-based healthcare, health outcomes. But now I think we're at the onset of what we in EY like to call as version 4.0, where we see the balance of power really shifting from physicians and payers towards patients and consumers, and data-driven platforms really enabling clinical decision-making. And you will see that as potentially a theme to a lot of digital deals and partnerships that are being formed over the last 12 to 18 months, both here in the region as well as globally. And I'll talk about that a little bit as well towards the back end of this presentation. Industry growth has wavered. As you can see, it kind of peaked in the early 2000s, and since then, at least the revenue growth rate of the big US and European medtech players has come off the cliff, and now we're starting to kind of, at least 2018, 2019, we were looking to bounce back. And interestingly enough, R&D spend as a percentage of revenue has also kind of kept pace or decelerated pace with growth in revenue, which is kind of expected. And this, in our view, creates a little bit of innovation gap in the industry. And you'll hear me talk about both innovation and growth gap as a key driver for a lot of the activity that we are seeing in the market. And this statistics is kind of telling to see how industry revenues growth rates have come down over a period of time. But this is clearly not reflected when you look at the stock price for a lot of the medtech companies in US and Europe. If you look at the blue line and the red line, both indicators of medtech stocks, commercial leaders being companies that have a market cap of about 500 million, non-commercial leaders being ones that have market cap of less than, or revenue of less than 500 million. You will see that they have done pretty well. So have companies that are in the digital health space. And when you compare that to even pharma, biotech, and the general S&P index, you will see that there is a big gap. So despite growth wavering a little bit, market participants do believe that the prospects of medtech companies continue to be good, and that's largely to do with the healthy profitability margins and also cash allocation strategies that have been adopted by medtech companies. And you will see that for a company, for industry that is dependent on innovation, we were surprised to see that 50% of the cash is used to pay dividends and buy back stocks. So it kind of shows a balanced approach to creating shareholder value. 50% of the cash being used for R&D and M&A. So this kind of talks about the strategy of companies to keep their stock price high, but what it does create is some form of innovation gap, and which needs to be addressed, and we'll talk about that as we move forward. Where do we see investment dollars going in? It's mostly to create therapeutic focus. We've listed out deals that have been done by some of the large medical device players, and as you can see, they have been buying companies as well as divesting. None more active perhaps than J&J, that has gone through a massive portfolio shaping exercise over the last 5 to 10 years. They have divested out of sort of their non-imaging diagnostic business, insulin pumps, stents, and they have invested during the same time in medical optics when they bought Abbott's business. And similarly, Abbott, on the other hand, increasing their focus on cardiovascular, whereas divesting out of other parts of the medical device business. So it kind of shows that there is a little bit of asset swapping happening in the industry, but more importantly, the fact that everybody is trying to build their therapeutic strength and focus through the deals that they're making. There has been a lot of interest in robotics, and you will see multi-billion-dollar deals that have been done in this particular space. All the big wigs, J&J, Medtronic, Siemens, have bought robotics companies in the last year, and this seems to be a trend that we are definitely noticing in the industry, the shift towards automation and robotics and using AI. In terms of digital deals itself, I think most of the investment is going into physician support, as illustrated through the yellow stack here. Physician support is essentially technologies that enable physicians to speed up diagnosis. It could be prescriptions, it could be other kind of analytical and decision support platforms. But we see a lot of digital deals being done in that particular space. There's also a lot of investment or deals that have happened in the patient support area, which is to improve access to patients and to improve adherence. Likewise with virtual care, remote monitoring, and sort of disease management platforms. We've seen that quite a bit as well, and it's definitely an emerging area of focus for digital deals. But that said, every year EY also puts out what we call as the firepower report. And through this firepower report, we're trying to identify balance sheet strength of life sciences companies, not just medical device companies, but also big pharma, biotech, and specialty pharma and generics. And the reason for this is that, at least in the digital health space, sometimes we see that a lot of these companies are competing for some of the same platforms, digital platforms, and therefore we decided to look at the combined firepower of these companies. And it was interesting to see that for the first time, the firepower, the balance sheet strength of the device companies had peaked, but yet at the same time, the amount that they had deployed to make deals in the market, the amount that they invested towards M&A activity was not as significant as pharma, and that is kind of also reflected in, if you look at the digital deals overall. I think between both pharma, biotech, as well as medtech, there were less than 150 deals and that were done, of which a couple of slides back we said there were about 40 deals that happened through medtech players. So the remaining 100 plus was done by pharma and biotech players. So this shows that they're deploying more of their balance sheet strength capital towards deal making versus medtech. But generally, I think it's safe to say that the investment in digital deals by life sciences companies has been low, and a lot of that has to do with the fact that while the costs are known, the returns are unknown, and many of the large companies struggle with sort of evaluation of these startup companies, and therefore hesitate in perhaps investing in them. What they do prefer is partnerships like the ones that Siemens has done with Mentais, or the one that Medtronic did with Viz AI. But in other cases, we have seen outright acquisitions. ResMed, the sleep apnea company that many of you will know, acquired Propeller Health, which is a respiratory sort of disease management platform, and they acquired that for about $200 million. The intention there was to understand how they can create a similar platform for sleep apnea. So you can see how a product company like ResMed is looking at investment in a digital platform, which is not necessarily in their therapeutic area, but looking to leverage that technology that Propeller has created, and then build that out from respiratory to go into to sleep apnea, linked but not necessarily direct in nature. So that's an example, I guess, of acquisitions, bold bets that have been made by medtech companies and investments that have gone into digital health, and also some examples of partnerships in that have been made in the recent past. If you look at the therapeutic areas, and if you look at growth rates across the different therapeutic areas or device segments, imaging, the growth rates have been declining, whereas we see a lot of interest in non-imaging diagnostic, which also shows that there has been a gradual shift towards personalized care. I think if there was one segment that is growing the fastest, and this is also true for our region, non-imaging diagnostics has been growing pretty fast. Globally, we see a growth of almost close to 12% in that particular space. Similarly, with research and other equipment, analytical devices, we see a lot of growth in that space too. AI, we all hear about new AI-based platforms on a regular basis. There are plenty of those on our region. I'm sure many of you on this call work with or have founded AI-based platforms. In the last 12 to 18 months, we've seen over 30 AI-based platforms that have won FDA approval. A lot of this is to support with diagnostics, but there are a few others that are also looking at early prediction of certain conditions, like the company that Medtronic invested in, Viscare. They're looking at early prediction of stroke cases. If you look at the specific area in which these AI technologies are being deployed, we see a lot of their application currently in cardiovascular and neurology, followed by oncology, a little less so in the other areas. Safe to say that these are acute conditions, and therefore the impact that artificial intelligence can have in diagnosis or even early prevention can have a disproportionate impact on overall healthcare costs and the burden on the society. So therefore, we can see why FDA is approving a lot of these platforms, or equally why investment is going into them. What we've also seen is that a lot of the big technology companies like Alibaba, Amazon, Apple, Google, etc., are also making investments in these platforms, especially the AI-based platforms. And there are plenty of deals. And Google has Verily, and each of these companies have their own AI-based platforms now that are building out healthcare use cases. And if you look at their sort of firepower, balance sheet strength, it trumps the collective firepower of the life sciences industry itself. So I guess safe to say that if the industry does not move quickly in bridging their innovation gap and identifying alliances, partnerships, and making investments in digital deals, there is a possibility that some of these big tech players could steal a march on the industry, especially when it comes to some of these new digital new age platforms. Slightly controversial thing to say in APACMed sort of forum, but I believe this is a legitimate threat and one that needs special attention from the industry players. And it does not necessarily mean that you compete with these tech companies. It could also mean that you find ways of collaborating with these large tech players to find ways to harness new digital technologies. This view is specifically for the APAC region. Just wanted to highlight the hotspots from an M&A standpoint. These are not digital deals. These are regular. This is reflecting regular M&A activity in the market. It comes as no surprise that China is the focus for a lot of deal making, followed by South Korea, Japan, some of the largest markets here in the region. In terms of focus from a device standpoint, diagnostic imaging has been the focus. I would say diagnostic and non-diagnostic imaging, although the bigger deals have happened in the diagnostic space, especially linked to some of the recent deals in Japan. And Ravi can talk about that a little bit because his company was at the center of some of this deal making. Equally, we've seen a lot of interest in cardiovascular, orthopedic, as some of the areas where companies have looked to make investments. Also, with a focus on the value segment, that has been a primary focus of large medtech companies. There is a gap in their portfolio, and they are looking to fill that through acquisitions. Now, in terms of health tech investments itself, the scene has been pretty active. There have been close to 340 investments that have happened in the region last year. This was just in 2019. Again, China, South Korea show up prominently here, but interestingly, from a digital health standpoint, India shows up on the list as well. Generally, disruption is high on the agenda for a lot of players in India. Also, the innovation scene is pretty active in India, so doesn't come as a surprise that we're seeing a lot of deals out there. In terms of the areas where investment is happening within the health tech space, medical diagnostics, we've listed some of the companies that have benefited from investments. 3D medicine, which is focused on personalized medicine, Chinese-based company that received a $40 million funding. ZY Health is a diabetes management platform. Cure.fit is a platform that helps address sort of behavioral traits and thereby influencing health outcomes. We've got another company, Homage, that focuses on elderly care and remote monitoring solutions. So a wide variety of companies that have received investment, and I would be obviously keen to hear the thoughts of the panelists on where they see interest from their own perspective, and technologies that could be interesting to their cause in the region. But this is again to make the point that it's venture capitalists that are making majority of the investments in the health tech space today. If you look at just Q1 of 2020, surprised to see that the space was still pretty active. A lot of deals got closed within the first quarter, ranging from Series A investments to Series D and F in some cases. There are some serial investors in health tech. Sequoia, as many of you will know, EDBI has been active as well of late, and there are a few others that have made significant investments in health tech. But I want to round off by saying that medical device companies are actively now pursuing partnerships and alliances with some of these health tech platforms. They are getting comfortable with the valuations. They are looking at different ways of developing partnership and alliances with them. Diagnostic imaging, AI-based solutions will remain in focus, and I'm very keen to hear the thoughts of the panelists and open to questions on from the participants to this particular webinar on what your thoughts are, as well as what some your questions might be. With that, Jeff, I hand it back to you.
Thank you, Abhay, for setting the context. There was a few questions that came through, but I think for the most part, let's hold them to the end. But maybe there was one quick one that came through a couple of times. Abhay, would you mind very quickly sharing the EY's definition of firepower? Abhay?
Again, I was on mute. Hopefully you can hear me now.
Yep.
So it's a combination of market capitalization, cash equivalents, and the ability to take on more debt based on their current credit rating.
Thank you. Okay, so let's move on to our panel. Very happy to have our as you've seen from the announcement or invitation, we have Warren Ma, Vice President, Asia Pacific for Fresenius Kidney Care. Aalok Mehta, General Manager of Southeast and North Asia from Hillrom. and Dr. Ravi Shrestha, GM and Senior Director, Global Healthcare IT, Canon Medical Systems. What I'd like to do is ask maybe each of the panelists to briefly introduce themselves, and a little bit about their company, so help give a bit more context for their thoughts in the rest of the panel. So maybe in order, no particular order, Warren, should we start with you?
Sure, Jeff. Thank you, and thank you to APACMed for the invitation to speak today. I am part of Fresenius Medical Care, which is the world's largest provider of products and services for patients with kidney disease. I oversee the kidney care portfolio, which is our provider business here in Asia Pacific, where we have about 400 clinics. Fresenius, very quickly, Fresenius Medical Care is, you may not all be familiar with it, it's fairly specialized on renal replacement therapy products and services, but we have grown to a fair scale of about 18 billion euro turnover. We treat about 1/10 of the world's patients who require renal replacement therapy, which is about 350,000. And here in Asia, we are about 1/10 of our global business accounted for here in Asia Pacific. So that's a quick intro.
Thank you. Aalok?
Hi, good morning, everyone. Thanks, APACMed, for this invitation. I'm Aalok. I head up Hillrom in Southeast Asia. Hillrom has distinct businesses. It's a market leader in hospital beds, OR equipment, and patient monitors. And a lot of people do not know we are one of the leaders in thermometry, so you can well imagine how busy we are in these COVID situation. We have a very robust R&D presence in Singapore. We have more than 100 engineers in our Singapore facility. Our Singapore facility is also the global head office for our respiratory care portfolio, which is one of our fastest growing businesses across the globe, which is headquartered out of Singapore. So very much looking forward to this discussion today on how can we partner more, given that we are growing in Asia Pacific. Thank you.
Thank you. And Ravi?
Thanks, Jeff, and thank you, APACMed, for the opportunity to be part of this panel. Ravi Shrestha, I'm the General Manager of Healthcare IT Division within Canon Medical. As many of you know, Canon Medical basically provides diagnostic modalities for CT, MR, ultrasound, the big irons. The division that I work with is the integration of all the output of that, from big imaging to the different clinical disciplines, the different ologies, radiology, neurology, etc. So my focus is very much on AI, on imaging, big data, automation. We're obviously headquartered in Japan, and the experience that I have in terms of medical devices stems from being a founder of a big small medical device company which went big and came out of Imperial College in London and delivered healthcare to 25% of the NHS. I then went to a CAD detection company where I did regulatory and took the company public in both US and UK. And then the journey within Canon, as Abhay said, we got acquired by Canon in a $6 billion investment. And it was a once in a lifetime opportunity for any company to purchase one of the big fours within medical diagnostics. So that's why I'm here. Back to you, Jeff.
Thank you, Ravi. Ravi, we're going to come back to you about when we get to talk about what you might do to, or what a Canon was looking for when they bought your company. So it's good to know. I want to start with getting the let's say corporate perspective on M&A in Asia Pacific, and really Asia. You can approach, or companies approach, M&A really from two perspectives. One is I guess the closing a growth gap, particularly in this region where we've seen it's the highest growing region, contributing globally. Is M&A being used to expand in geographies, particular markets, to add a presence in a particular business segment, therapeutic area, or on the other side is it more to close innovation gaps? So whether it's new technologies or even access to different business models. We saw, for instance, the example of ResMed essentially buying into almost partly a service business, for instance, right? or is it both? So maybe Ravi, to start with you, because I still see you on my screen. You know, how does Canon, I guess, now strike the balance between, you know, more traditional M&A to, you know, address growth gaps with innovation gaps?
Right. Yeah, that's a good question in terms of what the corporate perspective is with regard to M&A, right? So within Canon, generally, we are obviously a global company with global outlook to solutions, which can tune itself to regional variation. So when I was leading APAC for about 4 or 5 years within Toshiba, the regional variation was extremely important in terms of global solutions. So in our case, we look at global solution delivery, but more about, you know, complementing the requirements and the gap at a global level. So in that context, we have, I would say, 2 main drivers. One is obviously the general healthcare drivers. You know, Abhay was referring to quite a few of this, whether it's automation of care, imaging growth, personalized medicine, and N=1. You know, essentially converting data into information to knowledge and delivering value in patient decisions and clinical care. And we can't drive and deliver all of that all the way to a big company. So we look at the second part, which is all about innovation drivers. And innovation drivers is to complement what we have in terms of modalities, making sure that AI is real AI, not only automation, providing intelligence, providing the gaps related to early disease detection, and more importantly, I spend a lot of time talking about workflow and that can be delivered. And all of that within Canon is underpinned by our philosophy, which is all about made for life. So, you know, those are the key categories within M&A.
Thank you. Maybe Warren, you want to pick up that question as well?
Yeah, absolutely. I mean, Fresenius Medical Care M&A activities actually in our DNA. We were created through an acquisition. Our parent company, Fresenius, in 1996 acquired a chain of dialysis centers called National Medical Care. And the acquisition was so large that we actually had to spin off Fresenius Medical Care into its own separate entity in order to fund the transaction. And so since 1996, it really has been a history or a story of growth through acquisitions and partnered by organic growth. But if you talk about the difference between a growth gap and an innovation gap, it's been, I think, an evolution from that first group. Acquiring, just to use Asia as an example, in 2010, we tapped into an acquisition of Asia Renal Care, which gave us a network across Asia, at least in the provider space. But then from there, we've started to pivot as the renal industry has become in part commoditized on the product side and put under pressure from payers on the provider side by saying, okay, how do we look at patients at the center of what we do and support them in their associated requirements clinically? And so we've started to look into acquisitions of specialty hospitals. For instance, in Australia, we've acquired a large chain of day surgery facilities with an acquisition of Cura in 2017. In China, from 2018, we've been acquiring renal specialty hospitals. And this has allowed us to expand both our capacity as well as the type of innovative services that we can provide that support our patients at the core.
Thank you. Aalok.
Yeah, thanks, Jeff. You know, at Hillrom, on the same lines what Jeff mentioned, Hillrom has also evolved by acquiring different brands and different companies. From a beds manufacturer, started 8 years ago, today we are a tech company, a healthcare tech company, which we have evolved by acquiring different brands of Welchallyn, Motara. And so DNA is one of our growth pillars. And what we have learned over the years that now the evolution has to happen from the growth gap to more innovation gap when we start to look at local market. The areas where we compete, we have a lot of local players. We have Chinese players, Korean players, we have Japanese players. And as an American company, we can be a truly multinational only when we have strong local portfolio local needs are satisfied. And that's what we are looking at Singapore R&D Center. We call this initiative local for local. How do we look at China market? How do we look at India market? And have products which are developed for those markets, not just taking a Western European or American product customized to Asian needs. So this is very important piece of our strategy in ensuring that we cover that gap of innovation to meet the local needs in Asia.
Thank you, Aalok. Just to follow it up, Aalok, maybe a question. Can we look at, we're talking about M&A, but are we, can we look at broader range of models or tools beyond, collaboration beyond M&A? So we're talking about joint ventures. We can talk about licensing, commercial partnerships. Do you guys look at kind of the broader, say, array of potential collaborations or partnerships?
Absolutely, Jeff. This is a realization which I'm sure we are not alone. Many MedTech companies of our size that we can't do it alone. With the pressure you have on R&D funding, the different priorities, competing priorities most of our companies are fighting with, we need a network of partners, especially partners who are not just giving us an end-to-end solution, but help us on developing a part of the solution. We have a product which we developed in Singapore. It's a proudly made in Singapore, developed in Singapore product called West. It's a product brand called Monarch, very successful launch in the United States, where we had a plethora of partners looking at engineering of portability, electrical engineering. And this is a solution which we are now looking that if you can't have one company giving you all the solution at one place, can we break up the problem and work out the solutions? So, M&A is just not one way. It's just one way. We have, as you mentioned, licensing of technology, partners looking at a certain part of the project being delivered. So we are looking at partners across the board, not just for acquisition.
So Warren or Ravi, either one of you want to add some thoughts there?
Yeah, I would say that similarly, we try to partner with the right type of entity in the right market. As an example, in North Asia, so in China and the mainland, we've chose to partner with Lenovo, which is obviously a very large IT system, both hardware and software provider. And we're working with them to create a hospital information system that is tailored for our own needs, but also subsequently could be commercially available in the market. And so they have the scale that we don't have in that specific sort of IT production function. But on another side of it, in Japan, for instance, we're looking at partnering with a startup there in rolling out an AI delivery platform for diagnostics and prescription. So on that side, we have the expertise from the AI point of view. We have a huge R&D arm that's focused on specific AI algorithms and models related to the dialysis services. But they have, I think, an innovative platform for engaging with the providers that we don't. So it's about the right partner in the right market, and that's how we've approached it so far.
Okay, Ravi, maybe just to add to this, maybe a little bit of a different perspective would be, we've talked about, I guess, more, companies within our space. We've talked about technology providers. What about maybe more non-traditional partners, say, whether it's insurance companies or even, consumer technology platforms? So I guess the question is that, could we partner with someone like Grab, for instance, in terms of finding new ways to reach and support patients?
Right. I would say that Grab would be a model that would be useful in the future. But what we're looking at right now, everything is around collaboration and a journey. And as long as it fits within this with multiple different types of companies. The thing that comes to mind right now, and we're looking at this actively, are companies that do different types of data generation and data churning. Not necessarily imaging churning, not necessarily just providing the images and the diagnostics, but much more about providing the value from the data that there is, so that we can actually get intelligence and provide that to the CEOs and the CXOs of the hospitals for predictive decision making, right? So we're looking at that sort of companies that are away from the norm, away from the normal diagnostics, and those are important partnerships that we're looking at, and that comes back to your main question about, do we only focus on M&A, or do we look at other different avenues? With these types of companies, we definitely need to look at other different avenues, because that's a new journey for both companies, right? It's a new journey that looks at partnerships and how to develop that into an alliance, how to develop that possibly into a joint venture, and potentially lead to eventual M&A. So we're looking at many different types of companies within the ecosystem.
Thank you. So before we pivot a little bit to talk about, look more about the question of startups, maybe just a practical question, and feel free, any of you, to jump in. Where do you drive this sort of behavior, activity from? Is this something that your organizations do from the region, or is it really kind of come back to like a corporate M&A team sitting in headquarters somewhere, or some mix? How from an organization point of view, so from a startup, for the startups on the line, should they be talking to you, or is it more a connection to someone in headquarters to discuss this collaborations?
Jeff, I can take that up. From Hillrom's perspective, we've been working with Asian or Latin American, so outside Western Europe and US, from our head office in Chicago when it comes to M&A and partnerships. But we are changing that. We are empowering our regions. We are setting up M&A teams in Asia and other parts of the world, so that we can be closer to the startups. This is part of the journey we are making. These are the steps we have taken. But I do also want to give a message to the startups we work with. Often I have seen, working with the startups, they know their product very well. They know their technology very well. But it's also very important, especially when you're working with corporates, which is different from talking to investors or venture capitalists, that they understand the strategy of the company. They understand the focus area of the company. A lot of times, the fit between the startup's technology and the company strategy, that fit is missed out, and that's where partnerships don't go to the next level. So to answer your question, Jeff, we are empowering our teams in Asia to be more closer. But to make the decisive step, I feel homework needs to be done both ways, at the corporate side as well as the startup side, in understanding the strategy and the clinical focus area.
Okay, maybe let's just move on from that to what you guys consider when you're looking at startups, right? And this is hopefully now all the startups will have their notes, be taking notes for this. So really, first, maybe start with you, Warren. Are you looking for products with, or looking for things like products within a more specific therapeutic area, or more sort of, platform capabilities like, a data AI, for example? Where do you look more when you're looking specifically at startups, I guess?
Yeah. So I think I alluded to it a little bit in my opening remarks, but the evolution of our business from being a solely kidney disease focused company into a more of a general healthcare company, starting with patients with kidney disease. So many of you in healthcare would know, unfortunately, patients with kidney disease have a huge number of comorbidities. So we're looking now for specific companies that can help us in the adjacent treatments of those patients, looking at cardiovascular care, looking at behavioral, nutritional support, looking at ways that we can really extend our care coordination beyond just specific renal replacement therapies. So in a nutshell, that would be what we look at in terms of the themes of what the startups can do. But I would echo Aalok's point about the match between the DNA of our corporate entity and the DNA of the startup. And I've seen it work and I've seen it fail. And that comes down very much to managing the expectations ahead of time going into any kind of partnership, whether it's a joint venture, a licensing agreement, or all the way through to an acquisition. That very much needs to be done ahead of time rather than unfortunately discovering it down the road.
Right. Ravi, you want to pick up that question as well? Yeah.
Sure. Yeah, I guess I would point out two things. One is general, the other is specific. In terms of general, obviously we've got a whole portfolio of different products within our mix, and we're looking at mixing the synergy levels of the companies that are coming into play, together with the combined value creation of what we can do, right? So we're looking at synergies and catalysts that the portfolio companies can bring, and especially complementary products and value, whether it's USPs, whether it's patents, whether it's validated peer-reviewed papers, whether it's differentiated go-to-markets, or quantified deliverables around accuracy, sensitivity, speed, etc. All of those are extremely important. And then when we take it back to our local partners and local offerings, we want to ensure that we not only look at companies, but we also provide a platform for us to look at reference sites, right? So we've got within Southeast Asia a hub of Canon clinical global reference sites, whether it's Parkway and Mount E, or whether it's the top 4D CT intervention hospitals in Malaysia, Thailand, and Singapore. We've got a lot of references in India and China as well, and obviously in Japan. And in all cases, we're looking at innovators, right? So, and we're partnering with innovators within Southeast Asia. Within Singapore, we work a lot with A-Star. We're looking at smart startups within this region. We've got active discussions with, for example, a company in Mumbai who is doing chest AI, who is doing tuberculosis, who is doing COVID-19 based solutions called Cure AI. And we're looking at them very actively in terms of fulfilling those portfolios. So we try to make sure that we have different elements of the M&A mix in that context.
Okay. So just to follow up, would you take the approach more that you're trying to, I guess, plug a specific gap, so looking for that right company, the right startup that's plugging a gap, or would you approach it more like almost like a portfolio investor or a venture investor, making a number of bets and hoping that some of them pay off, and knowing that maybe some of them don't pay off? And I don't mean necessarily the company itself that you're investing in or partnering with, but maybe also could be the fit with your business as well. So what's the approach? Really looking for a specific fit, or really more placing a number of bets?
Right. From our sense, we have a very strategic outlook in terms of companies that could fulfill our portfolio. Right. So, it's all a case of looking at the horizon, looking at 3, 4, 5 years and saying, okay, this is the direction that we need to go into. We provide a lot of channels to market for new startups and new companies. And if complementary, they provide the tech synergy for combined business growth, then, from a financial perspective, and it makes sense, that's good, right? But at the same time, I think what is very important, being a Japanese company and looking at the principle of nemawashi, which is essentially looking at culture and how we grow the partnership together. Culture and the team is extremely important, not only within Japan, but because we provide a global outlook in terms of the different R&D centers where we have around the world. So essentially what I'm saying is, okay, companies should provide really compelling, validated reasons to essentially swing the make versus buy strategic decisions from our perspective to the buy quadrant, right? And that's a journey that we take together to get to that stage. right? So all the USPs that you can bring is extremely important. So it's a journey. And myself being in Singapore, we've got lots of R&D centers gathered, dotted all around the world. I'm part of the AV Solution Board that meets on a weekly basis globally. So, come to me from this regional perspective, and I take it up to headquarters very easily through that channel.
Thank you. I'll look, just to follow that up, should we be looking, for you guys looking, when you look for opportunities, is it really to support the business within Asia Pacific, or are you also looking at the technologies or partnerships that could actually have a global fit?
Jeff, we are looking at technologies which could help us build a local digital ecosystem. That would be whether we are building a gateway for clinical decision support systems, for example, on sepsis detection. So if we are looking at a solution which is going to be deployed in Asia or in Singapore or in Australia, we will be looking at local partners, because this is an ecosystem approach. We are looking at vendor agnostic solution platform to be delivered to the hospital. So if fitting into that portfolio, local solutions are required. But if you are looking at the innovation gap, which could be scalable, so scalability is very important, that we look at some technology coming from Singapore, Australia, Korea, which can be scaled to the globe. We would be looking at 5 clinical areas, whether it is simplifying clinical communication, earlier diagnostics, home health, accelerating patient recovery, or surgical efficiency. So we have these 5 areas defined. If a scalable solution, differentiating solution comes in, we can then look at it from a global perspective.
Thank you. Warren, maybe pivoting a little bit to, one of the challenges, particularly when corporates and startups get together, is maybe you could say difference in expectations from each side. So maybe a first point, I guess, is really, if you can touch on that, particularly, around what's the expectation that a startup is expected to make a tangible contribution to your revenue and profitability, in the near term, versus, something that's actually might be contributing in a different way. So how do you balance that discussion and the expectations from each side?
Yeah, it's a good question. I think the difference therein lies between a growth gap acquisition and an innovation gap acquisition. So in terms of a growth gap acquisition, our expectation would be that it would be accretive straight away. So we're looking at expanding capacity and driving kind of business as usual, or rather our core competencies into new markets and at a greater speed. When it comes to an innovation type acquisition, I think we have come in with a different mindset, and we're looking at building out a technical or a sort of a capacity that would, in the medium to long term, start adding value to the portfolio. So it depends on what type of acquisition we're looking, or what type of partnership we're looking at doing. But I would certainly agree that the expectations have to be managed carefully from both ends in terms of what we'd expect. And as a sort of slight a segue, one thing that I have noticed between MNC and smaller SME startup type approaches, particularly in Asia, is the approach to compliance and business dealings. As a German company with a large American presence, we are subject to every regulation under the sun within those countries, as well as extraterritorially. So we have very much a huge focus on doing things the right way. And our definition of right is very narrow. Whereas in many of these startup environments, you have to be nimble, you have to be comfortable to operate in ambiguous areas. And so for them, that's a very different way of doing business versus our fairly strict and cautious approach. So those expectations also have to be quite carefully aligned, not just from the type of business you're doing, but the way that you do the business.
That's a good point. And I guess it leads to the next question, which also touches on something that Ravi mentioned earlier about culture. So how do you strike the balance between shall we say, the corporate's need for control, whether it's management control, financial controls, compliance controls, and the culture, particularly, you know, what made the startup interesting in the first place, which is more, it's entrepreneurial, it's nimble, it's got new ideas. And we've all seen many examples of really interesting startups having their spirits totally crushed when they're acquired by corporates. And, you know, and so, and I'll throw this open to the panel. How do you strike that balance, if you will, between control and culture to really get the best out of it for everybody, you know, for both sides?
Right. Let me kick off by saying, you know, this is like a dating game in some ways, right? So we've got, you know, and this is a real serious corporate dating game in many ways. And right at the start, it's a case of making sure that both companies have the same type of vision with regard to the solutions that are being developed, and the fit, whether it's buy or growth, and whether it's for revenue or it's for innovation gap, right? So, you know, once that is there, it's a case of within a company making sure that the culture fits in with the collaborative partnership and delivery methodology, right? So, you know, in a big company, we need to ensure that we provide the right environment and the right opportunity to test and to integrate the innovation within the global R&D teams that we have, right? So that's what we do within Canon, and especially within the healthcare IT division. And within healthcare IT, it's a bit more easier than within a factory that develops products, I guess, right? So we have lots of different R&D centers and an R&D system that is based in the US with a big research center in Chicago. In Europe, we've got our Center of Excellence for AI within Edinburgh, and we have a lot of multimodality imaging R&D centers within France and Netherlands. And then Japan is obviously where the hub is and where the heartbeat happens and the real decisions happens there. But at the same time, I alluded to the field test sites that we have within Singapore and other parts of the world. And all of those are very important in terms of creating an ecosystem so that someone new that comes in does not feel lost within a big dating game. Okay.
Aalok, do you want to add any thoughts there?
Yeah, sure. You know, I can share a quick example without getting boring. You know, in our corporate office, a couple of months ago, I saw some folks in pink pants walking around. And I had to ask, hey, what is this pink pant? The team shared that we had acquired a company called Volte, a digital startup for 180 million. And the culture of that startup was every time you get a customer testimonial talking about how good the product is or how it has solved a problem, that specific division or that team will come to the office wearing the pink pants. That's the pink pant moment where you have got a customer testimonial. It's an example of how companies like us, we are learning that if we want to get our investment right, what you have bought the startup for, if you want them to grow, to the point Shresh made on giving them the environment to develop further so that they can scale up and we can get the benefit of our investment, we got to imbibe the culture as well. And it has to be both ways. So gone are the days where a big company could say that, hey, I'm going to take the startup and they fit in, otherwise they're gone. Now, I think there is a clear realization in corporates like ours that if we want to be nimble, we got to give the right environment for startups to develop. And this example was just an example of how we are learning to imbibe their culture. Sometimes it's awkward, but we got to do it.
Thank you. I'm not sure if the obvious question is, are you wearing pink pants right now? But we can't see.
I hope you didn't ask your question, are you wearing pants or not?
So that's a different. So I guess before, you know, on this point, I was thinking you guys, your answers were all reassuring because I didn't see any drop off of participants from the startup side. So I guess so far they're still all reassured that that the corporates will treat them well. So I guess that's a good sign. Just in the interest of time, I wanted to kind of the last sort of point is, we've managed to, to get, for more than an hour, and I think mention the word COVID once, which itself is an amazing achievement during this time. But to be honest, the fact that we're doing this in this way, in this webinar, as opposed to in person, speaks to this. So maybe just to we can on the wrap up before we get to questions. How is the COVID-19, the pandemic situation? How is it impacting your M&A strategies? Are you guys focused on the current business, or are you looking at this as way to think differently about further emphasis in a particular business you're already in, or is it sparking thinking about getting into a new business for kind of the world post COVID-19? So how is it changing? What is it doing to change thinking or change strategies, specifically around M&A?
Well, I think for Fresenius, I think some of you may have read in various journals and news reports that one of the unexpected outcomes of the pandemic has been a shortage of support in the critical care units for patients with multi-organ failure. And actually, it's a big part of our business. We do have machines that support continuous renal replacement therapy for patients with acute kidney injury. We also have a portfolio of extracorporeal membrane osmosis, heart and lung support. And so despite the situation, we've actually seen that segment of our business do extremely well. And we're very grateful that we have this part of our portfolio ready to support hospitals and healthcare systems around the world. So it has been a growing area of interest for us in terms of our business, specifically the critical care units, the ICUs around the world. But I suspect that in the next 6 to 24 months that we would be looking at complementary businesses or types of acquisition that we could make around the critical care business in terms of both product and services to respond to what we've learned from the crisis.
Aalok, Ravi?
Yeah, so if I may chime in, the most important thing is to have an immediate focus, right? We're looking at both sides. So from an immediacy, we're looking at the employees and the customers that are at the front line making a difference with our solutions. And in terms of what we're delivering to them, we're delivering a next level of safe and secure diagnostic equipment. And I'm sure Aalok can talk to this quite a bit, because we're looking at disinfectants, we're looking at how all the different medical equipments we can guide them so that they use it in the correct manner. And we provide them with knowledge and simple and clarified process of on-site and on-site-based prevention, so that we can prevent the virus transmission based on our equipment. That's extremely important, right? And then we also provide medical equipment, in some cases for free. For example, we provided CT scanners in new hospitals very early on in China, when the pandemic this was pre-pandemic, where China was building new 1,000-bed hospitals, right? So, it's important to be able to do that. And at the same time, we're developing our testing capability by developing rapid testing systems for COVID-19. So working with Nagasaki University, etc., we're developing an RNA-based testing scheme for testing the presence of virus. And it's very important that we do that so that we can use the RNA-based testing to test it in local areas. And we're almost there with that, and we're doing testing of patients based on those right now. Right? So hopefully it's not too far. And at the same time, with customers that already have our 3D visualization systems, we are offering them, solutions that have lung-based analysis and lung density solutions, pulmonary analysis, 3D MPRs, looking at airways, looking at solid nodules, and specifically looking at ground glass opacities, which is not the norm in most countries, but we've tested that based on Asian patients. And so we can offer that to different customers, not charging them for it based on what is required right now. So that's today. But then in terms of the future, we are refocusing on digitization, refocusing on how we dispatch and be much more responsive to customer service and support. Remote diagnostic tools that we already have today, that we're expanding that out, sustaining manufacturing input, looking at population health and digital health. All of those are within our mix, but I guess that's slightly in the back burner, but it's those are considerations that we're taking today.
Thank you.
So, all I would say is that these are unprecedented times, and sometimes crisis creates opportunities for change, right? So if you look at the Crimean War and nursing and Florence Nightingale, if you look at the Second World War and the NHS creation, this is an opportunity for us to do something good.
Indeed. Aalok, I'll give you the last word before we move to questions.
Sure. Our current situation is almost like a war room situation. We have products which go into the COVID infection control, thermometry, beds when demand. So right now our focus is ensuring that the customers get the products in the shortest amount of time. But I think there is our approach when this COVID situation is over. To Shrestha's point, I think this is going to be a transformative moment. And if you look back at SARS in 2003 also had a profound impact on healthcare systems. So we believe that this is going to have a profound impact on healthcare systems. So we are relooking at our strategy, whether it is from a home healthcare perspective, because we have respiratory care portfolio which treats patients at home, whether it is from a digital health perspective, surveillance, where hospitals will look at managing data of a vast amount of patients to predict or analyze such situations earlier. And also we are looking at diversification of the supply chain. I think this is very obvious. One of the learnings would be that supply chains need to be looked at, which countries you produce, where you produce. So, these things will happen after the COVID situation is under control. But I think, this is an opportunity to reset some of the way healthcare is delivered in this part of the world.
Thank you. So now we have a few minutes left to get to some questions. Abhay, are you still with us? I have some question for you.
Yeah, I'm here.
Hi, Abhay. So a couple of questions that came in were asking around robotics, particularly in terms of investments in deals in Asia Pacific. So what would be the view in terms of maybe that specific area? Is there something that we see increasingly happen, from companies? Is an area with startups maybe more involved? Or what's your perspective on that question?
Yeah, while we might not see specific robotic technologies being acquired here in APAC, certainly the ones that have been acquired globally will be launched here in this part of the world. Might not be applicable to all markets, to all channels, but we will see efforts being made by these companies to potentially launch them in the near term. I wouldn't say near term, but maybe medium term, considering the current COVID situation, to perhaps look at more efficient ways of performing surgeries and delivering care. So I think it's just a function of how you look at putting your investment to good use and where you find relevant technologies.
Let me, before I move on to other questions, just to follow up with that, I know we have a number of folks that were participating from the public sector, particularly universities. If any of you are involved in that, specifically in robotics space, if you can put maybe a note into the comments, then I can share it, just in terms of specifically to what's happening locally as well. And more broadly, we still have a few times. So if you have some questions or other comments you want to share with the group, please feel free to put it onto the chat, and we can pick it up. in the meantime, we do have a question I want to put to the old panelists. It's a question from Srikar, who is asking about, I guess the question of when is the right time to reach out to corporates? And he's asking about, you know, should they reach out while they're still, you know, they've completed their first human studies, so should they reach out to corporates now, or should they wait for, you know, once they've commercialized the product? So a little bit, the question is, you know, are you more of a product development company or a commercialization company, and what's the right time to reach out to partners? And I'll throw it open to the panelists. What's their perspective on that?
Well, I would say that from both a commercial hat, well, I would both a commercial hat as well as a product development hat within my role. You know, both these entities are not stopping now based on the fact that there is the impending crisis. Of course, the focus is there, but we're probably having a bit more time to rejig our priorities, to test our solutions a lot more, to basically have conversations with potential new startups. And we're actually doing a lot of work in terms of looking at companies and having discussions with the companies, right? Maybe the dollars are not going out right now, but definitely the analysis and the investment is there with regard to the analysis. So in terms of reaching out to companies with the solutions that you have, you know, there's no time like the present, because it's a slightly different type of focus, right? We all travel so much. We're not doing that. We all are busy with other priorities. We are busy with priorities, but we are refocusing the priorities. And quite a lot of the refocus of the priorities is for launch. It's for, you know, how to make a sustainable business. And this is the right time for companies to approach us now.
Martin, Aalok?
I would say, yeah, I would say for Fresenius, the acquisitions I've mentioned and the partnerships have actually been done within our corporate office, which we have a regional allocation to look at these opportunities. But I probably failed to mention that we also have a ventures arm, which doles out tens of millions of dollars every year into early stage startup companies. So in terms of that question, that arm of our business would be willing to look at much earlier stage, riskier type opportunities, but with a smaller stake versus, I guess, my side of the house, where I would look at people a little bit further down the evolutionary cycle for opportunities to invest alongside with, or to go into partnerships with. So different sides of our business have different risk appetites and different expectations in terms of what they would want to be looking at and to be doing with them.
Yeah, I would certainly not wait for commercialization to reach out to the companies. You know, just from a Hillrom's perspective, we are looking at early stage companies as well. However, I would say that you know, to have the story clear, clinical validation would be an important piece, where before you reach out, there must be clinical validation, at least from a Hillrom's perspective, which is an important milestone we look at before we want to work with a partner.
So I have a question from Sanjay, and he wants to know how do you all see the shift of care from clinic to home? I guess particularly through telemedicine, but I guess I would almost broaden that question a little bit too.
Yeah, you know, I can give it a shot first. I think this is going to be telemedicine is going to be one of the big winners out of the COVID. This is a transformative event for virtual care or telemedicine. You know, I think you may have seen some numbers. All of us may have read reports. Just to give an example, in China, we have the Ping An doctor teleconsultation. Their consultations went up 900% when the first news on COVID came in December. The visits to their site went up 800%. And when we talk to different customers, different partners, this is a common theme, that the fact that we are having this webinar virtually, it speaks a lot. So I think telemedicine is going to gain ground. The attitude of the payers is going to change with this event, that it's not something which was on the back burner from a reimbursement perspective. I think the way payers look at reimbursement is going to change, and we will see more regulation-wise, more reimbursement side changes in the coming months and years.
So we have a question. Oh, sorry. Go ahead. Go ahead.
I was just going to quickly add, I think the question of home really is it hits close to Fresenius's business, because we've actually been responding before President Trump's mandate to move dialysis from in-center to home. To actually pursue that, we acquired Next Stage, which is a huge, was a startup, but it was a big acquisition for us that had a big home portfolio in terms of hemodialysis. But personally, I've been doing my physiotherapy as I recover from my knee surgery via a remote telemedicine, so I can speak to that personally. It is doable. But it was, as Aalok said, a key driving function would be how payers respond to this new modality. And I think that he's absolutely right. People will see we really need to make it an option, at least in the toolkit of how we deliver care, because ultimately, if we limit ourselves to this kind of infrastructurally bound delivery of healthcare, then we subject ourselves to the same limitations and vulnerabilities.
So I think we have time for one very quick last question, and maybe I would actually answer this itself. It's from Robert. When you say early stage, how early for a technology licensing deal requires additional development? If I could take the easy cheating way out, said it all depends, I guess, on kind of where you're, on the specific technology and where it is, and unfortunately, that's probably not the most precise answer, but I think that's. What I would encourage you to do is reach out, through APACMed, for more connection. I see Gabriel has mentioned, another response about the platform they're setting up. So I think this is exactly the sorts of questions and discussions that the Founder Series is in fact set up to help make these connections and have those discussions. So with that, I see it's 12:29. So. I don't know if we get cut off at the stroke of midnight, so to speak, but I just want to take the time to thank our panelists again very much for all their great insights and perspectives. Warren, Ravi, Aalok, and as well as Abhay. So again, thanks on behalf of myself and APACMed for your participation. Gabriel, any last word?
No, thank you for all the panelists and to EY and for everyone who are on the call today. Thank you very much. And we look forward to seeing you again at our next webinar on 5th of May.
Thank you.
Thanks, Jeff.
Thanks, everyone.
Thank you.